We're speaking now with Mance Harmon. He is the co-founder of Hedera, and we'll be talking about the technology behind Hedera and Web 3.0 and what this means for the new global economy. Welcome to the show, Mance. Pleasure to host you here on Kitco.
Great, thank you. Glad to be here.
Centralization conference, one of the world's largest tech conferences. And now you previously served in the military and the Air Force designing missiles technology. I want to ask you first and foremost, before we get started on Hedera,
Sure.
Building missiles or building crypto, which is more challenging?
Yeah, that's a really good question. I'm not sure. They're both equally hard. No, the Missile Defense Agency, I worked to figure out how to protect us from incoming nuclear ballistic missiles.
Right.
That was very cool a lot of years ago for me. Crypto presents a whole new set of challenges, but you know, we're enjoying it.
And now you're working to protect us from the
From Web 2.0, the problems associated with Web 2.0.
Yeah, that's what you're protecting us from,
it.
financial destitute and decline. Now let's talk about Hedera technology. You co-founded this with Lehman Baird in, I believe, 2017, was it?
Correct, yeah, we started it. Lehman invented the tech earlier than that, 2015.
Yeah.
And we built that out and pursued private networks first, and in 2017 decided, let's build a public network using this new tech. And that's when it all kicked off.
In layman terms, what is Hedera?
So Hedera is a public network, a crypto network, what most people would understand to be a crypto network, similar to Ethereum or Solana or Algorand or some of the other, what we call layer one protocols. They form the foundation of the Web 3.0 technology stack and future economy. Hedera is one of those types of global public networks. It uses something called hashgraph that Lehman invented. It's an alternative to blockchain. It solves the same category of problems that blockchain solves, but far more efficiently and more securely than old school blockchain. And it has a governance model that is unlike anything else in the market. But fundamentally, we make it possible for developers to build arbitrary applications or decentralized applications, what we call dApps, on our platform to participate in this emerging Web 3.0 economy.
Can you give us an application that's being built in your platform?
Yeah.
Well, an example of an application?
Sure. So Galaxy is an application that's being built by Spencer Dinwiddie. He's an NBA star for the Mavericks. Spencer is bringing to market a platform built on top of Hedera that makes it possible for creators generally, they could be celebrities or sports stars or artists, creators generally, to create tokens that their fan base then purchase that gives them perks for, things like voting on what song to work on next, or what pair of tennis shoes to wear on court for a given game, or to participate in special previews of artist collections or songs or whatever. It's just a new channel for creators to engage with their fans called fan tokens. And Galaxy by Spencer Dinwiddie is one of those leading platforms in that space built on top of us.
And why Hedera? Why can't it be built on Bitcoin or Ethereum?
Couple of reasons. One, those platforms are extremely inefficient when it comes to energy consumption and usage. And the reason they're inefficient is because of the underlying technology. It makes it really expensive and unpredictable to use those platforms if you're building an application. If you're building an application as a developer, you're building a business, you need to be able to model what your cost of goods is going to be, your cost of the product. When it comes to those old school tech, like Ethereum, it's impossible to know how much it's going to cost to use the network because of the fluctuation in the token price.
We've come so far that we're calling Ethereum old school tech.
Ethereum old school tech. It's funny you say it. That's true. It's been around since 2015. And and things move very fast in the Web 3.0 world.
Well, Ethereum's getting an upgrade, I heard, right?
They say it's getting an upgrade. I expect it's going to happen. It's been in the work for many years. It keeps getting delayed. Even with the upgrade, it's still going to be the case that Ethereum 2.0 is far less efficient, far less green, if you will, than what Hedera is today.
Hedera runs on proof of work or proof of stake?
Hedera is proof of stake. So Hedera is proof of stake. It uses this algorithm called hashgraph that is the most efficient algorithm in the market. It's also the most secure. And when I say that, let me put it in context. And these are not my numbers. University College of London did a study on the layer 1 protocols like ours and Ethereum's that are proof of stake, not proof of work.
Yeah.
When it comes to Ethereum, even Ethereum 2.0, Hedera is 14,000 times more efficient, or uses less energy, that much less energy than Ethereum 2.0. But to drive the point home even further, if you just look at Visa, the Visa network for payments, Hedera's technology today is 74 times more efficient than the Visa network.
What does that mean in practical application terms? So you've got 74 times more efficient.
Yeah.
How can I experience that as a regular user of finance, as a regular participant of the marketplace?
Well, what it means is those companies that are going to be building their distributed applications on top of us or on top of some layer 1 platform, if they care about the environment and they care about ESG related interests, then they have to care about how much carbon footprint that their supply chain has as well. Yeah. It's not enough to just measure your own. All the products and services going into your product, you need to worry about their footprint as well.
If I build payment rails on top of Hedera, could I in theory make it the most or one of the most fastest transaction rails on earth?
It'll be both the fastest and it will be the least expensive in terms of carbon use.
How does it compare to layer 2 Bitcoin applications like Lightning?
Bitcoin, so Bitcoin fundamentally has a terrible problem as a layer 1.
Right.
We're 93 million times more efficient than Bitcoin.
Right.
Layer 2 applications help to address the problem, but they fundamentally can't get to the point where we are as a native layer 1 protocol, minimizing our carbon usage.
So what's your next step in, I guess, broadening the Hedera application or utility scope? How do you get traditional, if not DeFi, firms to start using Hedera for payment? How do you start getting the everyday person here at the conference here at Collision to start paying for their coffee with Hedera or HBAR?
Well, so there are 2 parts to Hedera that's unique in the industry. Number 1 is the technology. Hashgraph, as we've mentioned, an alternative to blockchain, maximizes security and performance simultaneously. But equally, if not more important, is the governing council of Hedera. Hedera is governed by today 26 global blue chip organizations, biggest companies in the world like Google and IBM and Boeing and Nomura and Deutsche Telekom and FIS, WorldPay going to payments. It's not just companies from a single sector, it's companies that span sectors and span geographies. They govern the network. They decide use of treasury, they decide the product roadmap, but more importantly, they are also users of Hedera. So they are part of Hedera, not just because they can govern, but because they have an interest in having a network like ours, an enterprise-grade network built by enterprise for enterprise, mission-critical use cases, and they are bringing their ecosystems to market on top of Hedera. So the payment rails, the financial use cases, the banks, the stable coins, and tokenization of bond issuances and all of that, that'll be done by council members already in play today, but not just financial services, ESG marketplaces, things like what Spencer Dinwiddie is doing, a broad range of uses by council members bringing that to market.
So HBAR is the native token, 1.5 billion market cap, I think is the latest figure I'm reading.
Yeah.
What is it used for?
HBAR is used both to secure the network and to make it possible for developers to use the network. It's bound up in both utility and security of the network. When a developer builds an application on top of HBAR, in order to use our network for their application, they have to buy HBAR off the open market through the exchanges. When they make API calls, they pay for those API calls using HBAR. So think of it in Web 2.0 terms. Yeah. You have organizations like Netflix that uses Amazon Web Services, and they pay Amazon in dollars. In the Web 3.0 world, it's similar, except it's no longer Amazon that's providing the service. It's a decentralized platform like Hedera, governed by all these organizations, and the application developers, the Netflixes of the world, rather than paying in fiat, pay in HBAR to consume those web services.
Okay. Would it having an external governing council make transactions or decisions more inefficient, some might argue?
Well, you know, it's interesting. There is a natural tension between the efficiencies of centralization in sort of a Web 2.0 context and the robustness of decentralization like we see in Web 3.0. We started obviously as two people, me and my co-founder, Lehman Baird. Over the years, we've both scaled and decentralized, and that results in a much more robust ecosystem and platform than it would be if it were centralized.
When you say that Hedera is secure, what does that mean exactly? Can we hack it? Is it hackable? All networks are hackable. It's just depending on the security of the network, how difficult it is to break the system, I guess.
So in the world of distributed consensus, in the academic world,
yes,
there is something called asynchronous Byzantine fault tolerance, and that refers to a set of properties that are the theoretical limit of what can be achieved in terms of security for decentralization, distributed consensus algorithms. You can't do anything better than that. That's been understood for decades. What Lehman discovered was a way to both achieve that level of security while simultaneously achieving the limits in terms of performance. There's always been this trade-off between performance and security. He solved that dilemma, that problem, in the form of hashgraph. That's what we call it today. So yeah, what we have is unique in the market in that it is asynchronous Byzantine fault tolerant. You can't do any better than that. And it's extremely performant enough and designed to address, again, mission critical, enterprise grade use cases. And that's what we focused on from the very beginning.
Okay. Now, the crypto markets have been suffering a crypto winter, some might call it. Yeah. HBAR itself is down about 50% over the last 12 months. Do you think this decline, this price decline in particular for HBAR, has jeopardized the security or the validity of the Hedera network? Are they correlated at all?
Not today, no. So today, there's one thing that you have to be concerned about ultimately, and this goes back to the earlier comments about the token being used to secure the network. Ultimately, what you have to be concerned with is whether or not a single bad actor or a group of bad actors working together can buy up at least a third of the total token supply. Yeah. If they can, then they can influence the network.
That's more or less, not exactly, but similarly to what happened with Luna Terra. We had a short attacker supposedly bought up, well, they had to have bought up a significant amount to have short attacked the network and then brought it down to a DPEG. You're not a stable coin, so the same analogy doesn't really apply.
It's an analogy, but yes, the tokens, if the token economy and the token economics are not managed appropriately, then bad things can happen to the platform. In our case, we have this governing council, these 26 global enterprises, each of them are running a node in the network, and there aren't anonymous nodes. So we're not susceptible to those types of attacks today.
Let's talk about Web 3.0. It's a key theme amongst crypto enthusiasts and blockchain entrepreneurs and investors today. Sure. Let's define Web 3.0. We've got skeptics, like I think Jack Dorsey called it, nothing but a buzzword. He said it's going to be very centralized, he said. It's going to be just run by VCs eventually. So what's your counter to that argument? How would you define Web 3.0?
Well, so first with definition, Web 3.0 is a set of, the way I would define it, is a set of protocols and a way of governing those platforms that is different than Web 2.0. So in Web 2.0, we have these centralized properties, like Twitter is a good example, but this is the way the world works today, centralized organizations that have total control of the platform, both in terms of the technology and its governance. Web 3.0 changes that, in that there is no single organization that is unilaterally running the platform. So if there were an alternative to Twitter in Web 3.0, it would be technologically enabled by lots, dozens or hundreds of nodes, each running a node in this distributed network, all independently in this distributed network. That's sort of the point of the council. We have these 26 organizations. Each of them run a node in the network. If one of them decides to be malicious, it won't work. It's decentralized trust. You no longer have to trust a single organization. You have to trust a collection of organizations, which is a much better trust model. So that's number one. But number two, it goes to the heart of governance. It's no longer the case in the world of Web 3.0 that a single organization, again, not just runs the platform, but makes decisions, fundamental decisions about the evolution of that platform over time, or the policies that govern that platform today.
I can understand decentralization from a network support infrastructure model, but some might argue that we don't need decentralization when it comes to governance of an organization. I mean, that just sounds like communism. Why would we want that?
Well, the question is, do you trust Twitter, right, not to pick on Twitter, but by example, do you trust Twitter to be wise in setting their policies for usage of the platform versus a whole economy or whole ecosystem rather of participants, including the user community, that can help influence and establish those same policies? It's democracy versus autocracy.
Well, how is the governing council selected?
Today, there is a membership committee in the Hedera Governing Council. That committee sets the standards for acceptance into the committee and extends invitations to those that want to participate. That's sort of step number one. Step number two is to invite other community members arbitrarily to participate. And then the final step in decentralization is to allow anonymous nodes in the network. It's a path from where we are today to full anonymity in operation of the network.
All right, so you were talking a little bit about Web 3.0 and how that affects investors, the new world economy. So explain how this new world economy will look like and how Web 3.0 will bring us there.
So I think what's important for investors to understand is that there's a confluence of technologies that are wrapped up in Web 3.0. There is the bottom layer, which we represent, Hedera represents, what's what we call layer one protocols, these distributed consensus or decentralized consensus protocols. And then there's tokenization that sits on top of that. And then there's this world of DeFi, or decentralized finance. When you take something like a supply chain use case and combine it with the elements of DeFi and tokenization, what you end up with is something that one of our council members today, Avery Dennison, is a council member with a platform today called Atma that's tracking 26 billion items through a supply chain. And they've just announced that each one of those items is going to have a digital twin in the form of a token. That token is designed for economic activity. As these widgets flow through the supply chain, their tokens can interface with DeFi, and programmatically, as part of this development process, production process, they can do things like get capital loans programmatically. They can, as they flow through the supply chain, they can get product insurance in a DeFi context. Later on, when they get sold off to distributors, or further down the supply chain, they will exchange the tokens that are associated with the widgets that are being developed, call them sneakers, for example. Yeah. And they'll take those tokens and programmatically they'll interface with a DeFi bank, a Web3 bank, and factor their accounts receivable. The AR, the accounts receivable, will be a token itself. They'll use tokenization with this new DeFi infrastructure to set up programmatic finance in a way that is far more efficient, frees up cash flow. Everything in the world that you see and touch, all products and services, are going to have a digital twin. We're going to live in a tokenized world.
What does tokenization mean for the company's bottom line? How does that, walk me through the income statement?
It's going to improve both their top line and their bottom line. And whenever you look at improved cash flows in the way that I just described, all of that is going to directly improve their cash flow efficiency.
Is this expensive to set up? Like, is there a huge CapEx component for this?
No, it's in fact, it's being done today.
Yeah.
It's already being done today by our council members. DLA Piper, a global law firm, top 3 global law firm, member of our council, has created a platform called Toco. And they are working with Atma in this, and Avery Dennison, to track the supply chain usage, the supply chain use cases, to do exactly what I'm describing. And what else is interesting is that if you have that level of transparency and granularity, you can track carbon usage as part of the process and automatically interface with carbon marketplaces to pay or offset your carbon consumption as part of the process.
Right. All right, final question. We have a global supply chain issue right now. We've been having it for about 2 years. Suppose we had tokenization put in place at every level of the supply chain. How would the world be different today?
It would be different in that there would be less, there'd be more transparency among all the participants in the supply chain itself. One way to think about, quote, blockchain in general is that instead of there being a single database that somebody manages and everybody else has to trust for a view into that database, instead, all of the businesses as part of a business network, if it's a supply chain, it's all the businesses in that supply chain that participate in that supply chain have a common view into this shared database that they help to participate in.
So suppose, all right, China has a zero COVID policy, nothing's coming out of the country, and my supplier is based in China, I can't get my raw materials. With blockchain, could I then see, all right, well, somebody else in Vietnam has the same thing, why don't I just change suppliers? Would that help facilitate that?
You would have more transparency into where the bottlenecks are, so that you can make the appropriate business decision.
All right, Mance, thanks for joining me here on Kitco. Excellent thoughts. And I look forward to speaking with you again. Mance Harmon here on Kitco. Thanks for watching. I'm David Lin.